The most sweeping revision to the federal tax system was signed into law by President Trump, and new data on consumer spending and wages, as well as the leading economic indicators, was released. Here are the headlines affecting your wealth this week. Stock prices broke new record highs month after month in 2017 as expectations of a corporate tax cut grew. Since Mr. Trump's election, stocks have soared about 25%. When the president signed the new tax law, stock prices barely budged. The news was already fully reflected in share prices. The big news affecting investors this week was that the index of leading economic indicators rose again in November. The Conference Board, which collects and calculates the index of 10 leading indicators every month, said the data suggests solid economic growth will continue into the first half of 2018. The LEI is about the best forward-looking indicator of the U.S. economy. Look at how it collapsed months before the last two recessions. Nothing like that is happening. To the contrary, the leading economic indicators have been in record territory lately and have headed straight up. Meanwhile, the latest consumer sentiment poll by the University of Michigan ticked down in November for the second straight month. Public opinion experts from the university said fears the new tax law might add economic uncertainty dampen consumer optimism. This is not all bad. Exuberance is what happened before the stock market bubble burst in 1999 and early 2000. Currently, sentiment is far from giddy, nothing like what preceded the last stock market bubble. Even though America's largest publicly held companies soared in value by about 20% in the past year, sentiment is not much higher than its historical norm. With the bull market in its ninth year, soaring in recent months, it's reassuring that consumers are not prone to overconfidently taking too much risk, and that stocks, as indicated by this objective measure, are not in a bubble. In addition, newly released consumer income figures were strong again last month and are accelerating. Employee compensation, the biggest component in consumer income, jumped 4.3% in the 12 months ended November 30th, 2017, way up from 3.6% just a month earlier, and every category of consumer income grew in the one-year period. Here you see what's left of consumer income after taxes and inflation. Real personal disposable income has been growing as fast as it did in the last expansion. This is an important fundamental driver of growth as real income drives consumer spending, and consumer spending accounts for 70% of economic activity. The last expansion was financed by bad loans that eventually collapsed and caused a global financial crisis and severe recession. This expansion is not built on a credit bubble, and yet real disposable personal income is growing at the same rate. This belies the way the economy is widely depicted by politicians, pundits, and almost all mainstream financial news outlets, which insists wages have been stagnant when the data shows that just isn't true. Despite lingering uncertainty about tax reform, a major political scandal, the nuclear standoff with North Korea, and plenty of other things to worry about, stocks have played a surprisingly good role as the key growth component in diversified portfolios, and share prices have continued to break new all-time record highs. A 10 or 15% drop could occur at any time on bad news, and the chance of a bear market decline of 20% or more increases as the 8.5-year bull market grows older. But leading indicators signal strength for 2018. The Federal Reserve forecast is bright, the world economy is growing in synchronicity with the U.S. for the first time in many years, and the new tax law is expected to bump earnings estimates higher. The bull market could continue, possibly for a long time, and head higher still.